Hey, what's going on, guys? Did you know that home prices are actually falling in some areas where we're seeing the population grow? And if the population is growing, basic logic would tell us that the demand would increase alongside of it, therefore pushing prices up. But that is not exactly what's unfolding in today's housing market. In fact, there is a shift taking place, the likes of which we've really never seen before. So in today's video, we're going to unpack some great data here by Redfin that indicates exactly what is going on with the supply side and the demand side of the equation. In addition to that, I recently heard an interview with Peter Schiff where he explains why today's housing market is different than what we actually saw in 2008. You're not going to want to miss it. But before we get started, please consider liking and subscribing. It helps grow and promote the channel, and I truly appreciate it. All right, these are the top 10 housing markets where buyers hope to move to. In other words, it's the migration trends, and these are the most popular areas that people are fleeing to throughout the entire country. The top spot's actually Sacramento, California, with this year they saw 5,000 residents alone move in, and that's coming from areas like San Francisco. Las Vegas saw 4,000 new residents, and they came over from Los Angeles. Orlando saw 3,700 coming from New York. And then even Nashville, Tennessee saw 2,800 new residents and coming from Los Angeles. What is taking place here, if you were to just zoom out and look at a map, residents are fleeing these high-cost coastal markets where affordability has become a major issue, and they're fleeing to areas that are seemingly more affordable. But what's interesting is in these areas, prices are not necessarily shooting sky high right now. Let's look at Sacramento first. Sacramento has a median home price today at $578,000. That's off a peak that we saw in May of 22 at about $610,000. So in other words, it's down about 5%. Nashville had a high of $470,000. Current median home price is $449,000. Las Vegas market is coming in at $420,000. That's off a peak that we saw at $450,000. Then if you take Orlando, Florida, in June of 22, we were at $400,000. Current median home price is $400,000. Essentially, it's just chopping along, staying flat. All right, now let's look at these inventory levels to see exactly what's taking place. I mean, we start with Sacramento here. We have 3,400 listings. If you go back 2 years ago, we actually had more. We were sitting at about 5,400. Orlando's basically flat at about 9,000 listings. Then we have Nashville about flat at about 9,000 listings. And then we have Las Vegas, which is actually the outlier here. They had about 12,000 listings 2 years ago. Now they're sitting at about 6,300. We have less supply, we have increasing population, yet home prices are going down. Now, a lot of this, of course, has to do with affordability, which I want to unpack here as well. Let's pick on Sacramento, California for a little bit, just because that's the market that I'm in. If we look at the median household income in the county, it's coming in at about $80,000. And if we do some very basic math, if we take the median home price at $578,000 and we divide by a median income of $80,000, that gives us a price to income ratio at about 7.2, which means if you basically take the annual household salary, home prices are at about 7 times that amount. A more healthy, affordable housing market would be anywhere from 3 to 5 times the annual household income. So if we had $80,000 in annual household income times 5, we would be looking at affordable housing at about $400,000. Now, I understand that first-time homebuyers are probably not going to be out there purchasing the median-priced home, but it is still very difficult in California to find a home at $400,000 or less. Let's take this a step further and unpack what the median home price would actually cost today for the typical borrower. Well, if we look at $578,000 with a 20% down payment, most first-time homebuyers do not put that much down, by the way, but let's just do it to illustrate my point here. If we look at where interest rates are today at about 7%, we account for taxes and insurance, we'd have a monthly payment of $37.87 per month. If you take that median household income of $80,000, divide by 12, you're talking about $6,600 a month in gross income. The take-home pay there at best is probably about 75% of that. So if we multiply that by 0.75, that would provide a net income of $49.50 per month, only leaving about $1,100 or $1,200 a month left over as disposable income. This type of scenario would likely put a borrower in a very tough position. Even if they could qualify for it, affording it would be a whole nother story here. And here's the thing, rates have actually gone down. We saw the 10-year treasury yield drop down to about 4.2%. So of course, this has improved mortgage rates, but it's still far out of reach for many would-be homebuyers here, which begs the question, what is going to happen in the housing market? Is it going to be substantially cheaper to purchase a home here in the next 6 to 12 months? Or is it different this time? And for that, I want to show you this clip from an interview recently conducted by Peter Schiff, and I thought his explanation was perfect. He explains why this market is a little different and what we might be expecting here moving into the future. Take a look.
What's going to happen to home prices? Are we going to see a crash? It's a little bit different than it was back in '08. So today, since the most valuable asset that the homeowner has, really more than his home, is his mortgage, a lot of people are going to want to stay in those homes.
So Peter is explaining right here that the debt has become the asset, and he's referring to mortgage rates that are sub 4%. So anyone fortunate enough to either refi or purchase and secure an interest rate that was that low, that debt has become the asset because it's maintained very low monthly payments.
Even if the home price goes down, their mortgage is so low that it still might be cheaper. Let's say I've got a house and I paid $500,000 for it, and it's worth $400,000. And so I'm underwater. Back in '08, the borrower would say, well, I'm wasting my money. Why am I going to pay this mortgage? I mean, I have negative equity. I'm just giving money to the bank. I'll go rent something, or maybe, I'll buy something else at a lower price. But even if you bought something at a lower price, if the mortgage was 8% and not 3%, even if I got a better deal on a home, my monthly payment is going to be higher.
Now, back in 2008, when home prices went down so much, a lot of folks went underwater. And at the time, they were unable to refinance, even though mortgage rates were actually starting to go down during that time frame. So they had negative equity. And it wasn't until, I think, '09 or 2010 when the government came out with this HARP program. It's called the Home Affordable Refinance Program, that actually allowed Fannie and Freddie loans to refinance despite having negative equity.
And the same thing with rent. A lot of people might be living in a home that they paid $400,000 for, that's worth $300,000 or maybe even $200,000, but their mortgage is so low that if they just walked away and they rented a property, their rent would be higher. So it's like, doesn't matter that I'm giving money to the bank. I got to live somewhere. I'd rather give it to the bank than a landlord. So that's an incentive for people to stay in their homes. And
so what Peter is describing, I believe, is what we're starting to see unfold in some of this housing market data. We have very low levels of inventory. Now, granted, if we saw a huge spike in inventory, it is very likely that it will put downward pressure on these housing prices. The challenge is that where will we see that inventory actually come from? Are we going to see a huge uptick in foreclosures? Likely not, because I think 70% or 60% of homeowners have rates under 5%. So their payments are historically low. It's only the ones that are buying today where their payments and rates are substantially higher than the overall national average. So if we don't see this huge influx in inventory and the economy stays strong and the unemployment stays relatively low, it's more likely that we'll probably see this housing market chop along here moving into the future. All right, that's gonna wrap it up for today's video. If you got anything out of this, please consider liking and subscribing. It really helps me out and I truly appreciate it. Take care.